right now. Okay, well, let's get more on the markets. Let's bring in Alec Young, Chief Investment Strategist with MAPSignals. Alec, it's great to see you. Happy Friday.
Happy Friday. Thanks for having me, Andrew.
What surprised you about the market this week? Did anything jump out for you?
I think, generally speaking, the big news this week was that inflation, which has been ticking down in the U.S. from its peak at 9% last year, bottomed out around 3% a month ago. It's ticked back up to 3.7%. So we've got inflation fears back on the radar, and interest rates are moving up here in New York. And so that's driving, a little bit of a pickup in volatility, as is typical seasonally this time of year. So I think that's been the big theme this week.
And you feel that people should pay attention to one number, 6%. Why is that important?
Yeah, well, we went back in history. We've got a lot of clients that are concerned about inflation, about rising rates. What does it mean for stocks? So we went back and said, what's the real pain point for stocks and bonds when it comes to inflation? And we found that when inflation is, in the 3 to 4% range, the S&P 500 has gone on to post 11% returns in the next 12 months. Similarly, we haven't seen big spikes in interest rates in that type of 3 to 4% inflation environment. It really takes inflation running above 6% to upset the stock market and the bond market, causing rates to go a lot higher. And obviously, bond prices move in the opposite direction of yield. So when inflation really heats up over 6% and bond yields go up, bond prices go down for investors. And that's what we saw last year. When we had the big spike in inflation, we saw both bonds and stocks do really poorly. This year, it's just a bit of a temporary uptick. We wouldn't get too worried about it derailing the bull market in stocks.
That's interesting, because our inflation rate, CPI, only barely above 3% right now.
Right, exactly. Yeah.
Where are there areas of the market that you think are being undervalued, unfairly sold by investors?
I don't know about undervalued, but the two areas that we like most at MAPSignals, we track institutional money flow. So what are the big pension funds? What are the big investors doing? We're seeing aggressive accumulation in energy. That tends to be an overall hedge against inflation and rising rates, because those things tend to coincide with higher oil prices, which obviously is good news for energy company profits. So we're seeing a lot of buying in energy. That's our favorite sector. And technology's been one of our favorites all year. We're staying with that just because there isn't that much rate sensitivity in the big mega cap tech stocks like Apple and Microsoft. They don't really need to raise cash in the bond market. They're self-financing. They generate a lot of free cash flow. So they're not as negatively impacted, their businesses, by a slight uptick in interest rates relative to companies in many other sectors where it's a much bigger headwind. So energy we like, as well as technology.
That's interesting. I mean, one possible idea then in energy would be by XLE, the energy ETF.
Yes, definitely. If you want the broad S&P 500 sector exposure, where you're getting the big integrateds like Exxon and Chevron, but you're getting the refiners, you're getting the exploration and production, you're getting the services companies like Schlumberger, Halliburton, a little bit of everything. XLE is a good catch-all if you want to play the overall sector versus specific names.
And what about QQQ, the NASDAQ ETF? I guess that'd be an okay way to play the NASDAQ 100 to get tech exposure.
Yeah, that's really very heavily weighted to mega cap tech. So, the big tech companies, Apple, Microsoft, Nvidia, Google, Meta, Netflix, make up some ridiculous percentage of that particular ETF. I mean, it's like half the value. So if that's where you want to be, that's a good way to play it if you're looking for more of a basket approach versus just an individual stock.
What about bonds? You track the behavior of big, sophisticated investors. What are they doing about their bond holdings? Are they because this move up in yields means losses on paper?
Yeah, I mean, the good news is the move up in yields we don't think is the end of the world for the stock market. A little, overdue profit taking after a great year, maybe, but not the end of the bull market, not the beginning of a big drawdown. So stocks we think are okay. Bond yields, there's based solely on inflation, bond yields shouldn't be going that much higher. But we do have a lot of issuance coming in the U.S. by corporations refinancing debt with a lot of maturities coming, as well as the Treasury selling an unusually high amount of Treasuries right now. That's putting upward pressure on yields. The consensus among the pros is that you want to buy bonds because if we get a recession or weaker growth, interest rates will fall and you'll get capital gains in the bond market on top of the interest payments. That view hasn't really been working. So we'd be a little bit nervous about that. Definitely like buying stocks on weakness here versus bonds. If you want to be in the bond market, the short end of the curve with for your safe money, you're getting the highest yields, 5.5%. You've got very little risk. In terms of long-term bonds, we'd be careful. The trend is higher with rates, at least for now. And that can be quite painful if you're buying 10, 15, 20-year dated bonds. So keep the bond exposure short would be our advice on bonds.
I suppose the American government, like so many other governments, is just going to be having to keep borrowing at ever higher interest rates. Well, not ever higher, but higher interest rates at this stage.
Right. Yeah, that's the long-term concern is that, obviously our borrowing needs seem to do nothing but go up over time. And now the government's having to borrow in the U.S. at 4 or 5% versus being able to borrow at, 1 or 2% for many, many years. So, will investors get nervous about that, force the U.S. government to pay higher and higher rates? That's the big debate. We ultimately don't think it's going to spiral out of control. As I said, inflation we expect to remain fairly tame, as well as the U.S. Treasury market is really the only game in town. For big global institutions looking for major liquidity pools, they don't have a lot of other places to go. So, there's always going to be good demand for that safe haven treasury. But certainly, given everything that's going on, the days of borrowing at 1 or 2% are over, and it's more of a 5% world now.